Hello and welcome to Financial Planning for Canadian Business Owners. This week we have a repeat guest, my friend Terry Ritchie, one of the foremost authorities on Canada-US cross-border planning. And I brought him on the show to talk about what the new presidency means in terms of potential tax changes. And with that, here's Terry. Terry, thanks for joining us.
You said something that was interesting. You said a new president.
Sorry, old president.
Oh, there we go. Yeah, something's happening. Something happened, huh? In the
Lots of things
world.
have happened. Lots of things have
Yeah,
happened.
yeah. No, it's an interesting time here and there. Here I'm in Calgary today. I'm in Arizona at our office next week. But yeah, interesting times here. I mean, we could talk about the capital gains stuff from last week in Canada and things like that. But
Oh, I've
I
got an
think
entire other episode on that. Don't worry about that.
So today we're going to talk about some U.S. taxation issues. So
Yes. So before we get
lots
started, though, let's just recap. Okay. So
okay.
for anyone who hasn't watched this before or doesn't know, the reason why this is important to anyone living in Canada is the US, unlike every other country in the world, except for Eritrea, hilariously, taxes
Yeah.
based on citizenship, not residency. What that means is that if you're an American citizen, doesn't matter where you go, you are always filing with the IRS every single year. That does not necessarily mean you're going to have taxes owing in the US. As always, the answer with financial planning is it depends, but for the most part, no. But it does mean you are subject to two separate sets of tax code. And guess what? There's no real rule book on how those two things come together. The cross-border treaty does a very small bit of that, but there's still a lot that's not covered. And this is why you need people like Terry and myself to wade through the complexity of this. So Terry, with that, let's turn back to the topic. Now that these
Well,
people know that they've got a file.
well, since you mentioned Eritrea, interesting enough, when I moved
Go
back
for
to
it.
Canada in 1995, part of my responsibility at another firm I was at was to go to Edmonton once a week. This is pre-Uber and all that kind of stuff. And so I'd land at the Edmonton airport, and every single cab driver I had always was from Eritrea. There's this large community that developed in Edmonton, and I knew what you just shared with our listeners about the U.S. and Eritrea. And I would often ask these guys, "Hey, are you filing your Eritrean returns?" They had no freaking clue what I was talking about, but it is interesting
And
that
then I think
it's
it's like a 2 to 5% tax and
yeah.
like good luck enforcing it. Like,
So if you go to Edmonton, if you don't do the Uber route and you take a cab, it's very likely that your cab driver will be from Eritrea. Um, so yeah, I mean, there's lots of Americans in Canada, and so we have to be cognizant of these rules. You'd mentioned, Jason, that U.S. citizens have an obligation to comply with these U.S. rules, and in some cases, there may be some additional tax that has to be paid beyond what the treaty provides and beyond foreign tax credit elimination. There's a couple of things that work for the benefit of Canadians I'm sorry, Americans in Canada, is that they get to exempt for the 25-year, $130,000 of their employment income can be exempt from U.S. tax. It's exempted under what's called the foreign earned income exclusion. And then what happens there is that that would be exempt from tax, but any other worldwide income would be subject to tax. And then you just play the foreign tax credit game in Canada to offset that. The problem is that depending on the filing status of the American in Canada, whether they're filing married jointly with their spouse, both two Americans, or if they have a spouse that's not a U.S. person for tax purposes, they have to file married separately. And so in those cases, sometimes there may be a level of tax that would have to be paid beyond the foreign taxes, because in the U.S., under the Obama administration, there was, to subsidize Medicare taxes, we had what many people would call the Obamacare surtax, the NIT
the
tax,
NIC.
and that investment
Yes.
income tax. And so sometimes, like I've had situations where you have a physician or a dentist or a professional that's has their spouse who's not a U.S. person, cranks out a dividend, and they're going to have some net investment income tax that would be imposed on that, 3.8% surtax imposed on that. So it's important to be proactive to kind of run these numbers for clients. But in most cases, for most of our listeners who might be U.S. citizens resident in Canada, the treaty works to their benefit. The foreign income exclusion may be worked to their benefit, and foreign tax credits can sort of solve that mess. That being said, there is the administrative burden of having to still comply with these rules. The filing of many people still use the term FBARs, the foreign bank account reports, actually called FinCENs, the Financial Crimes and Enforcement Network, the FinCEN 114. And then also there's another form that goes with the return in many cases called the IRS Form 8938. That's the statement of foreign accounts as well. that has to be disclosed within the return itself. The one thing we have to be cognizant of, though, is in December, a couple neat things happened for U.S. citizens abroad, for expats, and certainly those in Canada. Is that there's a Republican representative from Illinois that passed some legislation to create a citizenship versus residency-based taxation if you're an American who's working in Canada or working in the UK or something like that. We'll see if that ever comes to the light of day. What's been proposed there? His name is Darren LaHood, I think is his name, from Illinois. Is that if you are working in Canada, you would be able to exempt any of your Canadian source or any Canadian source income from the U.S. tax reporting. But if you have any U.S. source income, dividends, things like that, that would have to be picked up. If you recall, Trump on the campaign trail made a number of promises. Some he's trying to deliver on right now. And one of the promises was to sort of make a bit fair or a better system for expats that live or work abroad. So we'll see whatever comes of that. What LaHood is proposing might be part of that. So that's something that we might see. A couple other changes that came about in December, and you would be aware of this, is the issues that related to Social Security and the Windfall Elimination Provision. So what happened there is a new acronym for our listeners, for our viewers, WEP, the Windfall Elimination Provision, WEP. The U.S. loves to use acronyms for lots of different things.
Usually spell funny things though, like guilty or
guilty, TJ, TCJA.
Tax Person Job wasn't a good one. But there was another one where it's just like you purposely had to find an acronym for this, but guilty was the funniest of them all.
Yep. So in that case, so there are situations where you have an individual that lived in Canada, moved to the United States, worked for a U.S.-based employer, was self-employed and paying self-employment tax, and they were contributing to the Social Security system. They're paying FICA taxes and FICA contributions and things like that. Under the Windfall Elimination Provision, if they had worked in Canada and they also contributed to Social Security, if their contributions to the Social Security Administration, either through being self-employed or through their employer contributions, payroll contributions, did not exceed 30 years, then they were subject to this. I use the term clawback, which is a term most of our listeners know from an OAS perspective. But these individuals, when they applied for Social Security and they were also entitled to Canada Pension Plan benefits, would have a clawback somewhere between $0 and maybe $600, depending on the level of benefit, contribution, earnings, and things like that. And a lot of Canadians, when they be aware of that, were pretty upset about that. And it was something we had to have a discussion about. We wrote a lot of articles on our blog site about that. And there were many court cases that challenged this over the years, because there's really two camps that the WEP really impacted. The first camp, which I saw early in my career when I was working in Phoenix, is I had a lot of Phoenix police officers that would work there 20 years for the municipality, contribute to the municipality pension plan, not Social Security. They'd have 20 years, they'd get their full pension after 20 years, and then they'd go into the private sector. And then they'd contribute in the private sector, and they maybe pay 10 years and then retire. Well, those people were also impacted by WEP, a larger contingent, because they didn't have 30 years in there, okay? And then you had the Canadian who worked in the U.S., worked in Canada, and then the U.S. that also didn't have 30 years. So this was a big deal for a lot of people. And so in December, Biden on a Sunday, or one of his surrogates, that's a joke, signed this legislation to go ahead and basically eliminate that. So now what's supposed to happen is that those in 2024 that were subject to WEP, and I have a number of clients that were, several clients that were, they're supposed to get a lump sum check this year, and then any future payments would be grossed up for the WEP that was taken out. So that's been removed. Interestingly enough, I've written an article, it's yet to be on our blog site, that speaks to this. I mean, we worry about the long-term viability of Social Security because now that we've gone ahead and eliminated WEP, and we're paying more benefits to more people, what's the long-term viability of that as well? And one of our professional colleagues, Andrea Thompson, had written an article about this. I think I saw it on LinkedIn. That was sort of the first one I saw. And I kind of took that and wrote an article as well that will be in our blog site. So as we're having discussions with clients and doing some long-term retirement forecasting, Social Security viability is something that we have to maybe think about because of these changes. So that's a big change that happened. The residency versus citizenship-based taxation is another big change. Another couple big changes that may come about, and he's on a tear right now, is the
You don't say.
whether tips will be tax-free, and whether Social Security benefits will be tax-free, right? So
Well, to be
if
fair, Social Security is already partially tax-free.
that's correct.
Yeah.
Yeah. So he's looking to eliminate full Social Security benefits from taxation, which is very interesting because if you are domiciled in the US, not physically anywhere else other than the US, and you are receiving Social Security benefits, those benefits are partially tax-free, 85% of that benefit, depending on thresholds. It's either 50% or 85% of that benefit would be subject to taxation or report of taxation on the US side. And then many states basically reduce that. It's not taxed again on the state side, depending on what state you're resident in. Interesting enough, so if you are an American in Canada, under the treaty, you're effectively only subject to tax on that benefit, the Social Security benefit, in Canada and not the US. And so one of my big pet peeves against CRA is that, so for US citizen client in Canada filing a T1, receiving a Social Security benefit, it comes in, you're then entitled to take a 15% deduction so that you're taxed as 85%. And then what CRA in their infinite wisdom does every year, along with other stuff that they do every year, is they'll send out that review letter. And the review letter will ask, hey, dude, why are you taking this additional deductions on line? I think it's 249. I have to look it up. And then that's the Social Security deduction that you're entitled to. So every year you got to send in the copy of the SSA 1099 and support that. And every year, and they don't get it. So it's like every year it's just a consistent thing, and they'll get me going. But anyway, so that's
What's
something.
funnier is when they ask for proof of payment to the IRS, and the IRS does not issue notice of assessments like Canada does. So they're asking for something that they know is not issued, which is always comical.
Yeah, we could have a whole another podcast on like CRA and IRS war stories and things like that. But what would be interesting here is if Trump is successful and Congress will go along with this ride here to eliminate the taxation of Social Security benefits. You think Canada's going to do it too? They did give us the 85% treatment. Would they give us the 100% tax-free treatment? Highly unlikely, but that would be another compelling benefit why a Canadian might choose who's entitled to this benefit, or a U.S. person moving back to the U.S.
To retire in the U.S. Yeah. I mean, it's hard to
and now,
argue with that.
another benefit that many people aren't aware of as well is that if we know what the OAS clawback is and the threshold that kicks in when you basically sort of give it all back. If you move to the U.S. and you are entitled to old age security benefits, and you would be in many cases, depending on your physical presence in the U.S., in Canada. So at 65, you apply for that. And it's old age security and Canada pension plan benefits under the treaty are taxed the same way as Social Security benefits would be. So you kind of lump it in there and get that 85% treatment. There's no OAS clawback. So I've had clients who are millionaires.
Let's stop. It could be OAS clawback if you basically have Canadian sourced income in excess of the threshold, correct?
I've never seen that, Jason. So I can't.
I mean, let's also be honest. You'd have to have Canadian sourced income exceeding for a couple now $180,000 roughly to do that. So it would be rare if it ever happened.
I've never seen it. I've wealthy individuals that live in the U.S. They don't need the money, but they get the OAS. You can get it paid in U.S. You can get it paid in CAD. But that's one way to sort of subsidize Medicare premium payments that they may have to pay because they don't have enough credits to qualify for full, Part B premiums that they have to make payments on. So, anyways, that's another benefit. And then, so we have Social Security, we have the tax on tips. And then these maybe citizenship or residency taxation. And then the next thing that likely will happen this year is before the end of this year is again the whole elimination of the Tax Cuts and Jobs Act provisions that were supposed to sunset at the end of this year. And
So let's be clear, like the way it works in the US, unless you have a certain majority in Congress to pass a financial budget act, like the Tax Cuts and Jobs Act, then it is subject to a 10-year provision for sunsetting, meaning that it has to be, I mean, those things disappear. And we were, just so happens, when this was passed, the new old president was in office and that was his bill. And now he has an opportunity to potentially kick it down another 10 years.
That's right. And we saw this under the Bush administration. So legislation that was passed, basically, if it doesn't get permanently put forward, then at the end of the 10 years, it reverts back to the way it was on an inflation adjusted basis. So there was some concern that the estate tax exemption, gifting rules, tax rates, things of that nature would be going back to the way they were, which would be higher rates, higher thresholds, those kinds of things. So, but the biggest thing for our viewers and listeners and our clients is likely around the estate tax exemption. So the estate tax exemption for the 2025 tax year is $13.99 million. So effectively, I don't know why they can't make it 14, but it's 14 million bucks, right? So a married couple effectively has got $28 million. Unless their worldwide estate's not greater than $28 million, it's a non-issue at the federal level. There's certain states like Washington State has an exemption of $2 million. But from a federal perspective, that's a pretty significant threshold. And the significant thing about that threshold is that threshold also applies to lifetime gifts as well. So many of our viewers and you know that U.S. persons have a gift tax exclusion annually. If I wanted to give Jason, my friend, $20,000, I can do that. The problem is that the annual exclusion for U.S. purposes this year is $19,000. So if Terry gave Jason $20,000, I'd created a taxable gift of $1,000. So I'd have to report that on a gift tax return when I file my 1040. It's IRS Form 709. And then what happens is I would basically report the $1,000 gift, but the IRS gives me an exemption of a lifetime exclusion of $13.99 million. So no tax to pay out of my pocket. It just grinds that thing down. So
when is that check arriving, by the way? Yeah.
Pardon me?
When is that check arriving, by the way?
Yeah, by the way. I interact. I think I interacted it in
okay, yeah, $3,000 limit every day, but sure. Okay, fine. Okay, continue.
And then so that applies for US persons to anyone other than their spouse. If your spouse is a US person as well, gift all you want back and forth. Obviously, if they're in Canada doing it, there's obviously implications related to attribution, other kinds of things. But if you're in the US and you're gifting money back and forth between spouses, difference back and forth all you go. In terms of if you're married to a non-citizen spouse, so so my wife's the citizen, I am not of the US. If my wife had money, it's a joke. If my wife had, she does have money. If my wife had money, then she could go ahead and gift me some of her wealth. But there's a gift tax exclusion there because the whole logic there is if my wife has a substantial estate and she was able to give it to a non-citizen, and I said, hey, I ain't going to live here or be a U.S. person anymore, and I had a green card less than 8 years, I'm going to leave, and then I may be able to escape some interesting circumstances there for reporting and things. The limit for her to give to me is $190,000. So if you give to your non-citizen spouse, it's not 19, it's $190,000, and that's adjusted typically for inflation every year. Okay, so anything over and above that would then be a reported gift on the 709 return.
Excellent. So those are the big ones, right? What else we have?
Yeah,
anything
and then since we've been talking about this tariff wars, I think interestingly enough, we got a 30-day reprieve. Okay.
As of where we are right now, we're recording in February. I'm not sure when this is airing, but we have a 30-day reprieve for now. Yes.
Okay. So, and lots of things happened. I mean, good or bad. We don't want to get political here, but you can. Some people would ask, well, why is he doing this? Right. Well, we sort of know why he's doing this, but another reason why he may be doing this is that if we're going to have an elimination of Social Security benefits, if we're not going to have tax rates going up and maybe going down, of course, that's another thing that could happen this year. Not only will we won't have any sunsetting, we'll have those extended out, is that rates can all come down as well. There's even the discussion of even eliminating estate tax, having some type of system like we have in Canada, disposition tax with fairly healthy exemption amounts.
So let's just be clear about this. One of the reasons why the estate tax exists is because in the US, on death, you are able to have a bump up in basis, meaning that if you have a deferred capital gain, that gain is not triggered on death. Unlike in Canada, where unless it's being left to a spouse, if you have a capital gain of $500,000 on your stock portfolio or your rental property, that is taxable in the year of death. In the US, that is not a thing. The cost base, it gets passed on at the cost base, then gets increased to the market value. So no gain, passes on to everybody, no tax. But the estate tax does kick in if you are subject to it. So they're talking about moving away from their current system, potentially, which is the estate tax threshold, to one of elimination, potentially, of at least partially, if not entirely, the bump up in basis.
Correct. Yeah. So it's a moving target. And so now that we have these tariffs, that may be a way that may be some level, that revenue would be
Generation.
some level of mechanism to cover off the tax savings that might be promoted through and whatever. But what's interesting though, we're in an environment where the dollar sucks. We're at 69 cents today. Let's see where we are a month from now. So, there's lots of stuff in the press related to, and we've got clients who said, you know what, Terry, I think it's time for us to sell this place that we have in Arizona and go back, or this place in Florida. I can't afford to frickin' pay property insurance costs any longer. My HOA fees continue to go up. I didn't do proper planning, so all my sources of income are all in CAD. And my house has gone up quite a bit. And if I sell it now, I'm going to obviously pay a big capital gains tax consequence in the US and then on the Canadian side, and then offset through foreign tax credits. But I just got to get out of Dodge. And so we're starting to see more inquiries from clients about, does it make sense to sell my house, and what would that look like from a tax perspective? And there's withholding tax implications. It's a whole nother show. But we're starting to see that because of the dollar and because of the level of appreciation. And then there's some people just don't want to be down there for a variety of different reasons, and so on and so forth. So.
Well, it's, yeah. I mean, actually, interestingly enough, normally about a week after the election, I start fielding the move to Canada calls, no matter who wins, and didn't happen this time. So I don't know. Maybe they're looking at what's going on up here and saying maybe it's not as attractive as it used to be. I don't know.
Well, I've been doing this a long time, 40 years now, and so been through lots of different cycles, and there was a lot of saber rattling during the first go round, and a lot of people didn't follow through with it. I would say
they never
that
follow through. I mean, that's my history.
But we've seen certainly families that have come up because of it. They just want to raise their kids in a different environment. My logic is, it's messy everywhere. It's not perfect up here as well, but to each his own, and we respect that. And our job is to make them aware of what they're leaving and what they're getting themselves into. I mean, again, if you're a U.S. citizen moving to Canada, you're not going to escape all that stuff. You still have that administrative burden. Your planner needs to understand whatever you're doing from that perspective and from this perspective. And that's sometimes not very easy to find.
No, it's not. So thanks for the update, Terry. Very much appreciated. It is a complex subject, and it's something that any American living in Canada, or anywhere else for that matter, really needs to take seriously. So I thank you for your time. And before we go, where can people find you?
So our website is Cardinal Point Wealth. So it's www.cardinalpointwealth.com. We got tons of content on our blog site. So if you just go ahead and type in Google Cardinal Point blog, there's lots and lots of stuff. Many of the things I've been talking about today are there. You mentioned business owners. We've got lots of content related to if you're a business owner looking to move from here to there. We've got tax numbers, lots of really good stuff on there that I think people will find of interest.
Excellent. Thank you all for listening. If you enjoyed this podcast, of course, leave a review on your normal podcast subscription service. And if you're watching on YouTube, please like and subscribe. Thanks. Until next time.